Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
On today's Bloomberg Intelligence Show, we dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we'll discuss a leadership shakeup at the coffee chain Starbucks.
Plus, we'll look at why the U.S. Justice Department may be considering a breakup of Alphabet's Google.
But first, we dive into a big deal in the M&A space.
This year, Mars agreed to buy Kellanova for nearly $36 billion, and this brings together two major food companies in the biggest deal this year.
And this comes as the packaged food industry has been grappling with declining volumes, slowing growth, and a weakening global consumer.
For more, we are joined by Jennifer Bartashus, Bloomberg Intelligence Senior Analyst, Retail Staples and Packaged Food. We first asked Jennifer why this Mars Kellanova deal is actually happening.
There's a couple of things. The first is, from a Mars portfolio perspective, when it comes to the snacking category, they are heavily exposed to chocolate. And cocoa has been a structural issue in terms of cost for a while, and we think that's going to continue indefinitely. And so this helps them diversify out that snacking side of their portfolio, and it also helps them do a little bit more in emerging markets, which is an area where Kellanova has some strength.
So is it offense or defense from that perspective? Because it feels like it could be a combination of both, like diversify away from just pure cocoa, but also expand.
Yeah, I think it's a combination of the two. On the cocoa side, it's a little bit of risk mitigation, in helping to ease some of the costs they're feeling there. And traditionally, chocolate has held up actually really well through the pandemic and after the pandemic, but we're finally starting to see a little bit of weakness in consumer demand for chocolate, just because of food inflation. And so diversification will certainly help with that. And then, on a global basis, Mars has leading, they're in the top 3 market share in almost every region in confectionery. And so having more of the salty snack side and getting more into that can only consolidate their market share position in a lot of leading global, regions.
Jen, what makes this deal really interesting for me is the Mars company, because it's a private company. What do we know about Mars? Maybe, I don't know, size, capitalization. Did they ever talk to investors?
Very rarely, but what they have disclosed, their annual revenue is a little over $50 billion. So definitely a sizable company. And what I think is very interesting is when you break that revenue down, nearly 60% of their revenue is coming from pet food. So although everybody associates Mars with chocolate, the larger portion of their business is pet. And so they own the Pedigree brand, they own the Whiskas brand, and that is a big powerhouse for them. But that's part of the reason we think there actually won't be a lot of FTC pushback on this, because it's a smaller part of their portfolio, and the products are, there's really no overlap between what Kellanova does and what Mars does.
Amazingly, I did not know that.
I did not know that
at all. This is why we love Jen Bartashus.
Chocolate-covered dog food.
I mean, that would kill them, but sure, right? Dogs can't have chocolate. Isn't that a thing? So, Jen, does this mean we're going to see a lot of other M&A in the space? And if so, sort of who and where would we see that?
We've seen a lot of sentiment towards tuck-in acquisitions over the last couple of years, but there are some pressures that are affecting the industry. So when you listen to what all of these packaged food companies are saying, their priority for 2024 and headed into 2025 is regaining volume. But the problem is the consumer is not yet in a position where they're buying bigger volumes of food. And so M&A is a potential route to be able to better navigate the market. So, in this instance with this deal, we're expecting over $1 billion in synergies between Mars and Kellanova, coming from procurement, coming from manufacturing, things like that. So I think that this deal may spark at least some consideration for larger deals again in the packaged food space, as they're trying to find ways to contain costs, expand their geographic and product footprint at a time when it's hard to spend to spur consumers into buying greater volumes. So it may be an alternative for them.
In food inflation, you cover the packaged goods companies, you cover the grocery stores as well. those prices, while the rate of inflation has slowed, those prices ain't coming down, are they?
They're coming down, but very, very slowly. And so if you look on it on a basis, a comparison back to 2019, food prices are still almost 20% higher than they were in 2019. In certain categories where there's been relief, especially from the cost of like commodities. So as corn has come down and soy has come down and wheat has come down, sugar has come down, we've seen, a little bit of price relief, but it's going to take some time for that to really translate into something that consumers feel in their pocketbook, instead of just individual products being, either not getting increases or coming down slightly in price.
So which company in your space do you feel like is doing pretty well on the margin and the top line side? Because if margins are going to get squeezed, you need the top line to grow, but the top line is still really struggling with consumers right now. So who's managing that the best?
Well, up until probably the last quarter or two, Mondelez has actually navigated that pretty well. Because the demand for sweets and indulgences had held up pretty well. Companies that do have that exposure to snacking, generally speaking, are doing better overall than companies that are more center store. And I would point to Kraft Heinz as an example of center store, or Campbell Soup as a center store type of company.
What does center store mean? I haven't heard that before.
So center store is when you're in a grocery store, everything that's not on the outside. So it usually is like shelf-stable products. So think about your canned soups, your pasta sauces, things like that. Those are the pantry staples that most people, purchase. And then the perimeter is, of course, all of your fresh foods.
Our thanks to Jennifer Bartashus, Bloomberg Intelligence Senior Retail Analyst.
We move next to the home improvement retailer Home Depot. This week, Home Depot reported quarterly earnings and sales that top analyst expectations.
But the company cautioned that sales will be weaker than expected in the back half of the year. Home Depot cited high interest rates and economic uncertainty.
For more on all of this, we are joined by Red Brown, Bloomberg News Earnings Reporter. And we first asked Red to break down what Home Depot's numbers actually mean.
I think overall kind of the message that I'm sort of taking away from the results is this seems like they might have kind of found bottom. If we look the last 6 quarters, they've seen earnings top and bottom line shrinking. And then for the first time since 2023, things are flattening out a little bit. So yes, they cut the top line outlook, maybe a bit of a reset there. But I think there's a lot to be optimistic about these results.
Well, I guess one of the questions that I had, just being a grizzled veteran, having listened to a million conference calls, is, suggesting that maybe this is a little bit temporary, that maybe these are purchases that are being deferred in anticipation of lower rates. How does that kind of stand with you?
I mean, I think it does. I believe it a little bit more than it sounds like you two might, just because the one thing that analysts are pointing to a lot is contractors' backlogs. So those are, contracted projects that they are expected to eventually fulfill. It's just a matter of when the customers are ready to actually, follow through with that and say, yep, let's do it. Those are long-term projects, take several months. So it's not something that people are kind of likely to back out of. They're big. It's something that you probably need to get financing for as well. So it's a significant commitment for the consumer. This deferral mindset, I think, is an interesting way to spin the situation for Home Depot right now.
Yeah, that's interesting. So you have contractor backlog because customers want to get their project in the queue, but they're not putting down the money for it yet. So it's always like, is that going to wind? If the economy really turns, what winds up happening? So I guess if we just say, okay, we're at the trough, I wonder if we have any visibility yet into what the recovery then looks like for Home Depot. Yeah.
So I think if we look into what they said, the commentary around the guidance cuts, they said if it's going to be the same store sales, the top end is down 3% this year. They're saying that will happen if things stay stable from the first half of the year. And right now they say all signs point to consumer demand staying at that same level. They're not guiding towards the bottom end of that range right now. So right now that seems to be where the company is at, with some positive outlook here as well.
I'm just looking at the chart here and just thinking back to the pandemic. That stock, was up about 170% from, the beginning of the pandemic through the end of 2021. It's come off since then. So that was just such a moonshot for the company. What does the company say about the consumer or their business kind of now versus pre-pandemic? Did they ever put it in that kind of context?
Well, the reason for that ride up, if you remember, was because of so much DIY activity. Everyone was stuck home. I mean, I'm tired of looking at this shelf. Let me fix it. Right. Or I hate this paint color, whatever it was. Now, there's a little bit less of that just because we're spending less time at home. We have less time on our hands. And Home Depot has kind of accepted that they're not going to see those levels as much anymore. And what they are focusing, and a similar thing happening at Lowe's as well, is focusing on that contractor business. It's a higher margin business. It's a little bit more consistent. And we saw with their latest acquisition, an $18 billion acquisition for SRS Distribution. And that is part of this pivot towards, can we capture more of the market share for those contractors?
Oh, yeah. Love me some contractors. Working with some right now in the Berkshires. The allowance for my kitchen island was huge.
Are there good contractors up like in that part of the world?
Yeah, really good. Yeah.
Okay, good.
I mean, we went to one. We didn't do like comparison shopping because this company had like redone our roof, did our kitchens. Like we'd already worked with them for the last 10, 15 years. Red, when you take a look at earnings in general, so you're earnings reporter. Like this is your jam. What are some of the takeaways that we can learn from earnings in general right now?
I think with Home Depot, it's just a kind of repetition of this same pattern in retail, which is consumers are trading down. Last year there was so much, when is it happening? And it's kind of been slowly trickling in quarter over quarter. More people are trading down, or what that looks like on the ground is I'm delaying some of those bigger purchases, those bigger high margin for the company's purchases. I'm focusing on what I need. And I think Walmart will be the kind of example of that. Of people, I'm just looking at, what I need. I need food, I need groceries, I need toiletries, things like that. And then maybe I'll delay until I get a little bit more clarity on when I'm going to buy that TV.
So for Home Depot, I just think of walking into a Home Depot and boy, there's a lot of stuff. They're huge stores and there's a lot of stuff there. Talk to us about inventory management. I know for some of these big box retailers is huge. What are they saying these days?
So one thing to look for, the inventory, is actually the transportation costs have been coming down. So I think overall that just speaks to an easing of the supply chain for Home Depot. So they are able to manage a little bit better. In general, they're managing their costs quite well. That's part of the reason that they were able to kind of flatten out the earnings trough there. And yeah, I think overall, the inventory has been shifting well, and they have so much stuff, they're able to manage it well, and they're able to get the products that people want in the stores.
Our thanks to Red Brown, Bloomberg News Earnings Reporter.
Coming up, Starbucks has a new CEO. We're going to break down the leadership change next.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alex Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
We look next to a shakeup at the coffee chain Starbucks. This week, Starbucks ousted its CEO and picked Chipotle Mexican Grill's CEO Brian Niccol as its next leader. For more on all of this, we are joined by Jody Lurie, Bloomberg Intelligence Credit Analyst, and we first asked Jody for her reaction to this week's news.
I think as a credit analyst, we're always sort of hesitant when there's these full-scale changes that happen overnight and when you've had a CEO that's only been there since March of last year. So we have just only gotten comfortable with the concept that they're giving back $20 billion. And now you have two activist investors very heavily involved, one getting a board seat and pushing out the CEO with a new CEO. That could be a positive for the company long-term in terms of performance. But I do also think that shareholders might make it better than bondholders at this point.
Why do you say that? You think they're just going to maybe start returning cash to shareholders?
I think they'll get a little bit more aggressive with that, Paul. I mean, I think it could end up being the type of thing that they look at the company and that you sort of think about ways to sort of boost the value, whether it be spin off some entity or what have you. I'm not sure what entity they could spin off at a Starbucks because so much of the non-core business has already been peeled away. That said, I mean, I think that when you're dealing with activists, you're always sort of hesitant because you say, okay, how much are they going to risk the balance sheet? How much are they going to lever to get the company into a different spot? Now, that might be a short-term pain for long-term gain, but for bondholders, when you think about that short-term pain, that's not always necessarily the best thing. We have a long history of Yum, for example, which the new CEO was part of, when they spun off their entity Yum China, they ended up giving back so much of their money to shareholders.
Which then, to the point, begs the question, like, how is Starbucks actually doing from a bondholder perspective?
From a bondholder perspective, over the past year, they've been a little bit more volatile. Something that's very clear that we've been tracking is the Alt-D, the Bloomberg Second Measure data.
Yeah, okay, so wait, first of all, what is this?
Yes.
Because I got to be honest,
Sure.
I've never heard of this before, and you mentioned it. I knew you were going to talk about it, and now I'm a little obsessed with it.
It is pretty amazing, Alex, particularly when it comes to Starbucks, because the R squared, or the sort of predictive value of it, is pretty great when it comes to Starbucks in particular. So what it is, it's credit card and debit card swipes only in the United States, and Bloomberg aggregates the data. You can see it both on a year-over-year basis. You can see it on an actual value basis. If you look at the year-over-year where it's trending, it's actually very much down when it comes to sales and transactions, which is not surprising because they've had a couple of sort of disappointing points, one of them being geopolitics, so the AstroTurf effort related to the Middle East. The other portion is obviously China and the fact that they really went all in on China, and it's been a little bit of a disappointment. And then you've also just had consumers pulling back in terms of their spending on things like Starbucks, McDonald's, what have you. And so companies have been trying to just get people in the door. Now, if you look at it for, transaction value, or if you look at, the placer data, which we also have embedded on the terminal, even the placer data is down. So that's estimated visits. So people physically going into stores has been down recently. And so how does the new CEO get these people back? How does he get them comfortable with the Starbucks that we used to know and love? I'm not sure.
Talk to us about China, because I know you've flagged that before. Talk to us about China and what it means for Starbucks.
I think China means a lot of things for a lot of the companies in our space. I think it's been a very common word, more so than normal, when it comes to across the consumer and leisure space. So if you listen to earning calls this quarter, anyone from Hilton to Hyatt to even the cruise lines have been mentioning China either as an avenue for growth or as a disappointment for an avenue for growth. I mean, we haven't seen the value of China. We've seen sort of this sluggish, slow growth of late. And for someone like Starbucks, that last year they mapped out their plan and they said, we're going to be building out more stores in China, and that's our international growth plan, and that's how we're getting the company back on track. All of a sudden, you don't necessarily have that. I mean, that's kind of a big problem.
Yeah, and when they talk about like strategic options for that or partnerships, what does that wind up looking like? They're not going to spin it off, right? So it's not going to be a Yum and Yum Brands, Yum China kind of situation. So how do you digest that?
I mean, it could be a Yum and Yum China situation. Who knows what's on the table at this point? I mean, we could fathom any sort of measures. I mean, most of Starbucks stores are owned, but then when it comes to international, it's a little less so. And even places like, I mentioned the cruise lines, we were on a Royal Caribbean ship a couple months ago, and they had a licensed Starbucks. She always rubs that in our face,
doesn't she? She's always like, remember that time I was on that cruise and it was really awesome? Sorry, continue.
They did actually have a collector mug for Icon of the Seas that I did buy, which was a Starbucks mug, but it was Starbucks with a bunch of Icon of the Seas stuff. I had to get it. I mean, it was two companies I cover. I was like, I can't.
In one shot. Well, how about on the flip side of this transaction, Chipotle? What's the outlook there? What's the feeling there in the street?
So Chipotle is an interesting one because they don't really have that much debt outstanding. So it's one that, Mike Halen really deeply covers. We a little less so. We cover it from the standpoint that obviously it's a very important player in the space. It's that fast casual. We love talking about Yum, and obviously Chipotle sort of lines in perfectly with Yum, and it's sort of that intersection between Yum and Darden, which we like talking about. And so, I mean, I think, Chipotle obviously had a lot of negative headlines. We're talking 5 years ago, in terms of safety for their food, which is obviously never a good thing. Since then, they've turned around the company quite substantially. Now, I don't know what this means when you have a darling CEO jump ship and go to another company. I'm not quite sure what we'd expect there. I do sort of wonder what shareholders are thinking.
Our thanks to Jody Lurie, Bloomberg Intelligence Credit Analyst.
We move next to my favorite space, energy. We have something here at Bloomberg called Bloomberg New Energy Finance, and the idea behind it is to provide data on commodities, power, transport, industries, buildings, and agriculture, and new technology.
This week we looked at battery storage because you can't make a transition if you can't store the energy. For more, we're joined by Yayoi Sekine, Head of Energy Storage Research at BloombergNEF.
We first asked Yayoi just how much energy storage we realistically need going forward and how hard is it to get there?
To give you some context, when we talk about storage, we're talking about multiple types of technologies. You mentioned batteries specifically. We're really talking about many terawatt hours of battery storage capacity. That's a little bit hard to make it tangible, but just to give you some context on where the market is today, we are at about 1.2 terawatt hours of total batteries deployed. Terawatt hours?
Terawatt.
Yeah,
okay,
exactly.
Thank you.
Yeah,
Okay,
so
that's a lot, I'm guessing.
Yeah.
Okay.
When you get to teras, that's pretty big. It's bigger than
okay.
gigas.
Okay,
Yeah,
thank you.
Exactly. So essentially, where we're at is like we've had record years in terms of total deployments of batteries in the world, and this is in the form of both EVs, so batteries that go in electric vehicles. That's in the Teslas, the BYDs that you see being sold, as well as in stationary storage markets. So that's like big grid batteries that are installed to shift solar and wind generation to evening hours, as well as, some people are installing them in their homes because they would like to have some backup power, or they have their own solar system and they would like to shift some of that energy to their evening consumption. So that's quite a lot, and definitely like records still continuing to be broken there.
Is the efficiency of batteries, is that getting better, and how does it get better?
Yeah, I mean, good question there. So they have been getting better. So a lot of the trajectory around batteries and the improvement on technologies is very much focused around lithium-ion batteries. We've seen over the last decade improvement in many aspects of the technology, so becoming more energy dense, so you can carry more energy storage capacity.
Meaning like it's not 1 or 2 hours, maybe it could be days?
It could be days, although today the majority of the systems that we're seeing deployed are pretty much 2-4 hours. There is some extension of that, so that means like we can shift more energy to maybe not another like the next day, but maybe then a day in the next week. But primarily today, the majority of the use cases are generally 2-4 hours within a day.
Why is it so hard to increase storage life? Like, why is it so hard to go from a couple hours to longer?
So it's not technically hard to do. It's more about the cost. So once you start looking at multiple hours and multiple days, that means you have to add more energy storage duration, more capex to that project. And if there isn't really a mechanism for you to be paid for that additional investment that you're adding, the more batteries for duration, you're not really going to want to do that as somebody who's building these batteries. And so it's a lot of it is related to what is the market paying for today and what's the market needs today. In the future, our expectation, and based on BNF analysis, is that we're going to see longer duration needs, and that's primarily because we're going to need to be shifting more solar and more wind generation to other hours and for longer periods if we're decommissioning those gas plants that are currently providing that service.
What are the next, in terms of batteries and storage, what's the next thing that lay people like Alex and I and John, we should be looking for, thinking about?
So some exciting things, aside from the market level stuff, which is like, as I mentioned, record levels of battery capacity being deployed, probably it's more about like EVs becoming more affordable. So if you want to go into the store and buy, instead of buying a conventional car, you want to buy an electric vehicle, actually having that at a price point that's more accessible for your pocket. That's essentially a factor of multiple things, one of which is the battery costs. So for the battery costs to come down, which is a big portion of an electric vehicle cost, that actually makes those vehicles
Is it coming down?
They are coming down.
Okay.
And that's actually a major story for this year. It's the fact that we've seen batteries at record low prices, especially in China, but that's starting to have a knock-on effect in other markets in the world as well. And so there's a lot of factors around the markets related to that. There's huge overcapacity in the battery manufacturing sector in China today. And then there's at the back of that intense competition of the battery manufacturers in the Chinese market. And that's essentially really putting a lot of pricing pressures downwards in that market.
Before I let you go, do subsidies help from governments to make all this happen?
Yeah, absolutely. So I think in the context of the U.S. specifically, we've seen a lot of gigafactories being announced in the U.S. at the back of the Inflation Reduction Act. They provide multiple types of subsidies. A major one is for the production of batteries, battery cells and battery modules, which are the building blocks of batteries that you see in electric cars, as well as stationary storage. And that's a significant amount, $35 to $45 per kilowatt hour for the production of these batteries. And so we've seen a lot of gigafactories announced, although as of late there's been some delays to some of those announcements because of the slowdown around EV demand growth.
Our thanks to Yayoi Sekine, Head of Energy Storage Research at BloombergNEF.
Coming up on the program, lingerie retailer Victoria's Secret's appointing a new CEO to lead its turnaround. More details next.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alex Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We move now to big tech and Google. This week we heard the U.S. Justice Department is considering breaking up Alphabet's Google.
This comes after a landmark court ruling found that the company monopolized the online search market.
For more, we are joined by Jen Rhee, Bloomberg Intelligence Senior Litigation Analyst.
We first asked Jen what exactly the DOJ is thinking about doing when it comes to Google.
You know, now push comes to shove with this case because the DOJ hasn't really talked too much about remedies. It's been working on liability and it won pretty resoundingly. So now it has to think about what it wants to ask the judge to do to remedy what the judge found to be anti-competitive about what Google's been doing. And I have to say that the idea of a structural request or a breakup's been around since 2020 because the Department of Justice inserted it into the first complaint it filed back in October of 2020. It said we may be asking the judge for structural relief as necessary. And it's something the DOJ is thinking about. And I don't think it's a surprise. Why not go for it? You know, there's kind of a big is bad mentality right now. And if that's the case, then you want to break apart these dominant firms and they have this win. Why not try to go for the gold on this?
So if that's the case, though, I mean, is it one of those things where they're going to go for it, but really it's going to be okay and they're not going to do it and they're going to do something else? and then what's that something else instead?
Look, I think they will. It's going to be up to the judge. And my gut here is that the judge probably would not order that kind of drastic relief. I just think that the judge was really specific here about finding that it's the default agreements that Google had entered into that were anti-competitive. And what was harmful about them was that it did not allow the rivals to gain the data they needed through searches to have scale to be a good enough search engine. And those are two big issues. So those are the two things that are anti-competitive. My suspicion is the judge will say, hey, no more default, no more payment to be the default search engine at these key search access points. And by the way, maybe you need to share some of this data you've collected over the years through all these searches with these rivals to give them a chance to get better. Those are two options. And Leon Island's reporting was great about also this AI issue and concern about using its dominance to get a lead in AI. And maybe the DOJ will do something there too.
Because the AI thing is the one that I think has a lot of people concerned, not investors, but just people thinking about AI and what it means for privacy and all these other issues. What does it mean for jobs and security and all these things, which the market, nobody has an idea, and certainly not the courts or regulators here. But what are Google's defenses here, given that they did lose that antitrust case?
I think one of the things Google will point to language by the judge, and actually there was quite a bit of it in the complaint, about the fact that it really has been a great innovator, that it's been ingenious, that the fact of the matter is it developed the best quality search engine in the world by putting in money, by putting in innovation, by hiring great engineers and ingenuity. The judge did say that. And also the judge, by the way, said even though Google had obtained a monopoly position, it continued to innovate, even though it didn't really have to once it gained that spot. So Google will say, look, you have no guarantee that that same kind of innovative spirit will be behind the parent of this new company. If you cleave off Android or cleave off Chrome and it's run by some other entity, that might not be in that entity's DNA. You have acknowledged that we're innovators and that we'll continue to innovate. And it makes the most sense for these assets to stay in our hands. That's what I think Google will say.
All right, our thanks to Jen Rhee. She's Bloomberg Intelligence Senior Litigation Analyst.
We turn now to news in the banking industry. Bank of Nova Scotia has agreed to buy a minority stake in the U.S. regional bank KeyCorp for about $2.8 billion.
This comes as Scotiabank makes good on its plans to invest more capital in the U.S.
For more on this, we were joined by Herman Chan, Bloomberg Intelligence Senior Analyst for U.S. regional banks.
I first asked Herman to walk us through what KeyCorp actually was before Scotiabank got involved this week.
KeyCorp, regional bank based in Ohio, Cleveland, strong presence in commercial lending and has a really robust investment banking capital markets capability for its size. On the flip side, the bank has been really pressured by the higher interest rate environment. It got caught off sides a little bit by both its hedging strategy and its investments in low-yielding securities when interest rates were near zero. So its margin and profitability has lagged the peer group over the past couple years. That being said, things were improving and didn't require any additional capital infusion. There was on a path to self-help. Margin had already reached the bottom, but now with the $2.8 billion capital infusion from Scotiabank, they can accelerate that earnings profitability improvement story.
How long does it take to get something like this done? Like, has this been in the works for a while or what?
Yeah, it seems like based on both the calls that KeyCorp and Scotiabank conducted, the CEOs had ongoing conversations about a potential investment. From what I understand, Scotiabank wanted to expand in the U.S. And had done a lot of due diligence in looking at opportunities, and KeyCorp was their top choice. Mm-hmm. So it adds a great earning stream and exposure to the U.S. for Scotiabank, and for KeyCorp, it really improves its capital and liquidity and really puts them on offense rather than playing defense for the past couple of years.
How are the banks like KeyCorp doing as interest rates may fall somewhat soon?
Yeah, I guess I would contrast it with the tumult of March and April of last year. The banks had largely been very defensive pretty much up to the end of last year, reducing its lending capacity, trying to improve its capital and liquidity ahead of both fears about deposits leaving and also higher regulatory burden. Right now, it seems like they're in a much stronger position. Capital has been built up. They're back to lending. The only issue is there's not a lot of demand, and the banks are positioned for potentially lower interest rates that can improve some lending going forward. They've hedged a lot of the potential rate decline. So they're in a fairly good position to really prosecute the opportunity.
What about deposits? Has deposit flight stopped, particularly if rates wind up coming down? I'm just waiting for my markets account to all of a sudden start to tick lower on yield. Where are we here with that?
My high yield savings account is already ticked down in anticipation for rate cuts. So American Express, I'm not a big fan of that. I would say that deposits have really stabilized. There's no real rush to build deposits now because, as I said before, there's not a lot of demand for the lending side. So you don't need a lot of deposits to really fuel that muted demand appetite out there for loans. That being said, the deposit costs aren't rising either, and they're pretty stable because the Fed's stabilized the Fed funds rate for a bit now, and we'd expect some stable margin depending on the bank. Some could be down over the next year just based on their balance sheets.
Are there other potential targets for investments from other banks in this kind of scenario?
Yeah, from what I understand, that there's a unique way of accounting for the Canadians. A small portion of investments in financial institutions has a positive capital calculation. So it might be more focused on the Canadians in general. But that being said, that we have seen some pickup in traditional M&A activity in the United States. Discover Capital One is the biggest one that we're still waiting for regulatory approval on. And then there's some smaller banks that have done some deals as well. So it seems like that the activity is going to rebound even more once we get rate cuts.
Our thanks to Herman Chan, a Bloomberg Intelligence Senior Analyst for U.S. regional banks.
We move next to the lingerie retailer Victoria's Secret. This week we got news that Victoria's Secret is poaching the top executive from Rihanna's lingerie brand to lead the retailer's turnaround.
Hilary Super will replace Martin Waters, who was terminated as CEO and resigned from the board.
For more on this, we are joined by Mary Ross Gilbert, Bloomberg Intelligence Senior Equity Analyst covering retail.
We first asked Mary if this week's news is a big deal for Victoria's Secret.
I think this is a big deal. Being a woman-focused brand, we think that Hilary Super, and as you mentioned, she was just the CEO at Rihanna's brand, Fenty X Savage, and that's a lingerie company. It's a teeny, tiny company, but Hilary has 3 decades of experience. She was the chief of the Anthropologie brands more recently. And prior to that, she's worked at a number of other brands, including American Eagle. And speaking of competition to Victoria's Secret and why they've lost share, American Eagle has a brand called Aerie. And that's about, $1.6 billion business. So Victoria's Secret has lost market share, but they have been in a turnaround mode for the past 3 to 4 years. And we're starting to see some traction, but we really think that with Super's understanding of the consumer, working with multiple brands and really getting the brand heat, we think that she could really make a difference here at the helm. So we think this is good news. And of course, it comes as they say that they just beat 2Q earnings. They gave preliminary estimates for their second quarter.
When did things really fall apart for Victoria's Secret? What was the trigger?
The trigger was really the sort of Me Too movement. And given that it was a brand that was sort of focused on the perspective of what made women sexy from a male perspective rather than from the female consumer perspective. And that has shifted. It used to be part of limited brands. It was then spun off. They've become a more inclusive brand. I mean, how many companies out there can say that they have 100% equal pay across the business? I don't know of any others, but they have achieved that. It's third party documented or certified, I should say. So they've made tremendous progress. They've really improved the lineup. But I think kind of getting it to the next level and really getting that turnaround to a point where they can get back to growth, I think this is the right time at the moment to pivot and bring in somebody like Hillary Super. So I think it's very, very exciting for the company at this time.
Well, Mary, if the industry has changed, if the lingerie part of the business has changed, where is success coming from in that new world?
Yeah, well, so there's a couple things that happen. I mean, the category had been growing for many years and had been expected to grow, but they did experience a slowdown last year, but we're already starting to see improvements in the category, at least in the U.S. Internationally, by the way, Victoria's Secret is growing in the double digits. I think in the last quarter, international was up 11%. So the category did weaken, but it looks like it's starting to turn back up again. And really what happened is with this sort of Me Too moment, it became more inclusive. And so Victoria's Secret has adopted their brands to be more inclusive. And, once again, to come from the perspective of a woman and what the woman needs, and it's a whole assortment. And if you go into the stores, you will see a dramatic improvement in the assortment that they have. In the employee culture, I would say it's very positive, very exciting environment when you go into the stores, but they do need to remodel most of the stores. They've only been able to touch a small percentage of the store base so far. So there's still more to go. And then the Pink brand is really at an earlier stage of a turnaround, but we're already seeing fall assortments really improve. And they've brought on Natalia Bryant as a brand ambassador. So that's pretty exciting.
Yeah.
Okay. We're heading in the right direction.
Our thanks to Mary Ross Gilbert, Bloomberg Intelligence Senior Equity Analyst covering retail.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.